Modern banking is a vital part of our economy. It's the backbone that allows money to flow from those who have it to those who need it, offering services that facilitate the exchange of goods and the growth of businesses. But what exactly makes up the modern banking system and how does it work? What are the hidden mechanics behind this intricate network that drives our financial world? This is a question we will answer today. We'll delve into the inner workings of our contemporary monetary system, uncovering the processes that dictate how banks function, make profits, and impact our everyday lives. So join us on this journey to demystify modern banking and understand the mechanisms that keep our economy moving. So the first thing to understand about modern banking is that it's not just about keeping your money safe or making loans. At its core, modern banking is a critical component of our economic infrastructure. It's the backbone that enables the smooth functioning of our financial markets by providing essential services that facilitate the flow of money throughout the economy. In fact, the primary role of a bank is to act as an intermediary between those who have excess funds, savers, and those who need funds to invest or spend, borrowers. This process of financial intermediation is crucial for channeling capital towards productive activities, thereby promoting economic growth and stability. But why is banking so important to our daily lives? Well, banking plays a pivotal role in our everyday lives in ways we often overlook. For instance, when you deposit your savings into a bank, they in turn lend a portion of that money to others, creating a ripple effect that boosts the economy. These loans enable businesses to expand, invest in new ventures, or manage their cash flow, thereby generating jobs, increasing productivity, and stimulating overall economic growth. Moreover, banking services like payment processing, wire transfers, and online transactions make commerce seamless, allowing individuals and businesses to engage in financial activities with ease. Furthermore, banks play a vital role in managing risks and fostering financial stability. Through diversification, they spread risk across numerous borrowers and investments, mitigating potential losses and ensuring the safety of depositors' funds. This function is particularly crucial during economic downturns, providing a safety net that bolsters confidence in the financial system. Despite its critical role, the banking sector isn't immune to challenges. In recent years, the industry has faced significant disruptions driven by technological advancements, shifting customer expectations, and evolving regulatory landscapes. The rise of fintech companies has intensified competition, compelling banks to innovate and adapt to new technologies such as mobile banking, artificial intelligence, and data analytics to enhance efficiency and customer experience. Moreover, regulatory changes aimed at strengthening financial oversight and mitigating systemic risks have also impacted the banking sector. For example, stricter capital requirements and liquidity ratios imposed by financial authorities necessitate that banks maintain higher levels of reserves, influencing their lending practices and profitability. In essence, understanding the mechanics of modern banking is paramount in comprehending how our financial system operates and impacts our daily lives. From facilitating transactions to managing risk and driving economic growth, banks play a pivotal role in shaping our economic landscape. Now let's uncover the hidden mechanics within. Modern banking is often perceived as a straightforward service where customers deposit their money with the expectation of earning interest, while simultaneously providing funds for loans to be issued to other individuals or entities. However, this perception only scratches the surface of how banks truly function. Contrary to popular belief, when you deposit money into your bank account, they don't simply hold onto it. Instead, they put it to work primarily through lending operations, which constitute one of their main sources of revenue. By lending your deposited money, banks earn interest, which contributes significantly to their profitability. This practice enables them to offer various financial products and services to their customers, while also generating profits for shareholders. The lending activities of banks drive a substantial portion of their income, highlighting the crucial role that these institutions play in the financial ecosystem. So basically, the way it works is that when you put your money into a bank, they don't just keep it there. They use it to make loans to other people or businesses. When they make these loans, they charge interest, which is essentially a fee for borrowing the money. This interest is how the bank makes most of its money. So basically, the bank acts as a middleman between people who have money and want to make some interest, and people who need money and are willing to pay interest. This helps the economy because it allows people to borrow money to buy things like houses or cars, which helps stimulate economic growth. Another hidden mechanic of modern banking is that banks fund loans by borrowing, rather than relying solely on customers' deposits. To understand this aspect of modern banking, it's important to recognize that banks don't keep all their money in reserve. In fact, they leverage a small portion of their deposits to grant loans, with the expectation that not all customers will withdraw their money simultaneously. In scenarios where many customers request withdrawals, banks may face liquidity challenges. However, they typically have contingency plans such as borrowing from other banks or selling assets to raise funds to meet withdrawal requests. This mechanism enables banks to manage their liquidity positions effectively, ensuring they can fulfill withdrawal obligations while continuing to lend to customers. Banks employ sophisticated risk management techniques to assess creditworthiness, setting aside funds to cover potential loan defaults and implementing strategies to mitigate risks associated with lending activities. By adopting these measures, banks aim to protect themselves against adverse outcomes, ensuring financial stability and safeguarding depositors' interests. Overall, banks play a crucial role in channeling funds from those with excess money to those who need it, facilitating economic growth and development. Through lending, banks generate revenue, contribute to economic activity, and help individuals and businesses achieve their financial goals. Their ability to borrow and lend strategically enables them to manage liquidity effectively and support a wide range of financial needs. Now, another fascinating aspect of modern banking is that, according to some economists, the entire monetary system creates money through a complex series of banking operations. According to this view, the money we use is not backed by any physical commodity like gold or silver, but rather by the intricate web of our financial system. When you deposit your money into a bank, they can lend out a significant portion of it, creating new money in the form of bank deposits. This process enables individuals and businesses to access funds beyond their initial deposits, stimulating economic activity and facilitating transactions. Economists argue that this mechanism is fundamental to our monetary system, enabling economic growth and driving financial markets. However, it's important to note that this perspective has its critics who contend that money creation should be linked to a tangible asset or a reliable metric such as gold. They argue that decoupling money from real value could lead to instability and potential manipulation within the financial system. The debate surrounding the nature of money and its relationship to our banking system continues to be a topic of ongoing discussion and research among economists and financial experts. Now, the evolution of modern banking has been profoundly influenced by regulatory frameworks established by government and financial authorities. These regulations play a crucial role in shaping the structure and practices of modern banking, ensuring stability and mitigating risks within the financial system. One significant regulatory framework that has shaped modern banking is the separation of commercial and investment banking activities. This principle, often referred to as the Glass-Steagall Act in the United States, was implemented to prevent conflicts of interest and protect depositors' funds by limiting the ability of commercial banks to engage in risky investment activities. Another key regulation is the establishment of central banks, which serve as financial intermediaries between commercial banks and governments. Central banks, such as the Federal Reserve in the United States, play a vital role in controlling the money supply, setting monetary policies, and providing financial stability to the economy. Furthermore, regulations regarding reserve requirements and liquidity ratios have been instrumental in ensuring that banks maintain sufficient reserves to cover potential withdrawals and manage their liquidity positions effectively. These regulations aim to enhance the stability of the banking system and protect depositors' interests by ensuring that banks have access to sufficient funds to meet their short-term obligations. Capital adequacy requirements, on the other hand, ensure that banks maintain adequate capital levels to absorb potential losses and continue operations during times of financial stress. These regulations typically require banks to hold a certain percentage of their assets in the form of equity capital, providing a buffer to absorb shocks and maintain financial stability. The regulatory landscape for modern banking continues to evolve in response to financial crises and technological advancements. Ongoing efforts to improve transparency, enhance risk management practices, and address systemic risks contribute to the resilience and stability of the modern banking system. Another hidden mechanic of modern banking is that lending significantly influences economic outcomes, either stimulating growth or potentially contributing to instability. When banks provide loans to businesses, it enables them to expand their operations, invest in new ventures, or manage their cash flow. This access to financing fuels economic growth by facilitating job creation, innovation, and increased productivity. Conversely, if banks tighten lending standards or reduce the money supply, it can restrict the flow of funds, potentially leading to decreased investment, slower economic expansion, and even recessions. Furthermore, lending practices can impact asset values, including stock prices, property values, and commodity prices. For instance, easy access to credit can boost asset prices, while tight lending can contribute to their decline. Monetary policy decisions made by central banks also influence lending rates and the availability of credit in the economy. By adjusting interest rates and reserve requirements, central banks aim to foster lending, promote economic activity, and maintain financial stability. It's important to note that lending practices and monetary policies have broader implications for employment levels, inflation, and overall economic well-being. Excessive lending, coupled with loose monetary policies, can contribute to asset bubbles and financial instability, while responsible lending and prudent monetary management support sustainable economic growth and financial resilience. Last but not least, technological advancements present both opportunities and challenges for modern banking. On one hand, technology enables banks to enhance efficiency, reduce costs, and offer innovative services to customers. Digital banking, mobile payments, artificial intelligence, and data analytics have revolutionized the way banks operate and interact with their customers. However, this progress comes with challenges as banks must continuously invest in new technologies, manage cybersecurity risks, and adapt to changing customer expectations. Embracing technological advancements and striking a balance between innovation and security are crucial for banks to remain competitive and serve their customers effectively in an ever-evolving digital landscape. And with that, we've reached the end of our exploration into the hidden mechanics of modern banking. We've uncovered the vital role banks play in our economy, demystifying the processes that drive our financial world. From lending and economic impact to the influence of regulations and the role of technology, we've delved deep into the intricate workings of our contemporary monetary system. If you found this video insightful and would like to support our channel, please don't forget to hit the like button and subscribe. Your support means the world to us and inspires us to continue creating informative content on financial topics. Thank you for joining us on this educational journey.